So your pricing, your ads budgeting, and your cash planning is all done against a profit margin that is actually out of date. I'm Karl from KKG Accountancy. We look after the numbers for e-commerce founders. Your gross profit margin showing your latest management accounts, are you sure that they reflect your current level of spending? Because for most e-commerce brand that we look at, that number has been locked in at launch and rarely touched again after. So the factory puts its prices up, the freight's moved, the pound's weakened, but your accounting system is still showing a cost that's been input a couple of months back. So your pricing, your ads budgeting, and your cash planning is all done against a profit margin that is actually out of date. Under FRS 102, your cost of inventory isn't just your purchase price. It's all of the costs incurred into bringing your inventory into its current location and condition. So that includes the purchase price, but also the freight, the duty, the insurance. Once you combine all of these costs together, you arrive at a fully landed cost. But one thing to remember, if you have slow moving inventory or seasonal inventory that you're selling for a lot less than you were initially, you need to reflect that loss of value into your landed costs. The law is essentially saying that you need to value your stock at the lower what it costs you and what you're actually selling it for after selling expenses, otherwise called the net realizable value test. Finally, FRS 102 is giving you two valuation methods for your stock: FIFO, first in, first out, and the weighted average method. The former is actually taking a lot longer to reflect price fluctuations into your cost of sales, whereas the latter is actually giving you a much more current cost of sales figure. They're both compliant. But here's where it goes wrong in practice. There's real difficulty into ensuring that your landed cost reported in your management accounts is a current reflection of your level of spending. And the reason for this is there can be up to 5 different invoices received from 5 different suppliers at 5 different times, all related to one shipment. Your factory invoice upon dispatch, your freight a couple of weeks later, your handling from the port, and your haulage from the carrier, not to forget the customs invoicing for the duty. And this complexity is the reason why most accountants will wait until the end of the year in your statutory account preparation process to review all the invoices received and update the landed cost calculation. They'll then reconcile that new updated figure against your stock take ending inventory and your total units sold, thus correcting the position of your balance sheet and profit and loss. And what happens the rest of the year? Your management accounts are not reflecting the level of your current spending. It's very important to be intentional about tracking all of the invoices that make up your landed costs and to do so on a regular and established basis. Here is an example. A founder launches a hero product. The factory cost is £10, then £1.50 for the freight, and another £1.50 for duty and clearance. That's a total landed cost of £13. They sell it for £43.33, giving us a 70% gross margin. Then 2 quarters go by, the factory raises its price by £2 because of a raw material shortage. Ocean freight increases by 90 pence per unit, your duty fees are now higher too. When you add it all up, the real landed cost isn't £13 anymore, it's £16. Same product, same selling price, but the margin you think is 70% is actually 63%, and the management accounts never showed it. Here are 4 controls you can implement to ensure your margins are current. First, you want to maintain a unit cost master sheet. Every purchase order and its related invoices, supplier invoice, freight, duty, and so on, gets reviewed on arrival and you update the master sheet with the latest price point. Secondly, you'll need to reconcile your units sold against your updated landed cost calculation rather than applying a flat percentage of revenue, which is exactly what hides the margin drift in the first place. Now, these first 2 controls are really a tracking job, and their software is built for it. A dedicated inventory management software like Seed7 or Unleashed does it automatically. Every cost is landed against the right batch and your margin remains current. It's not cheap though, and it takes real setup to run properly, so it tends to fit more established businesses. If you're not there yet, don't let that hold you back. A well-built spreadsheet does a very similar job. Your third control is to ensure that all cost fluctuations are built into your decision making as soon as they happen. When a shipment lands at a materially different cost, the founder is informed about the margin drift before the next pricing or ad spend call. And lastly, keep an eye on the stock that's worth less than it costs. Your slow-moving or end-of-line products have an impact on your profit, and their loss in value needs to be reflected in your accounts. Now here's a sanity check you can perform yourself on your 3 highest volume products. Find the unit cost your accounting system is using and the date they last changed. Rebuild the true landed cost from your most recent shipment, including invoices from your supplier, freight, duty, clearance, insurance, inbound transport, and all other costs incurred in bringing your inventory to its current location and condition. Compare the 2 landed cost figures and then take the gap and multiply it by the units you've sold this year. As a rule of thumb, anything more than about 5% of this year's profit is worth acting on now. And if you find that you've been getting it wrong, remember that your year-end accounts will still come out correct. It's just that the number wasn't being kept current. The real added value of monthly management accounts comes from being intentional about the timeliness of your record keeping. Running your monthly accounting cycle with discipline will feed directly into the quality of your decision making. If you'd like us to pressure test your real landed costs and your reporting cycle, that's exactly the work we do. The link is in the description. I'll see you in the next video. Take care.